As global markets continue to react to an evolving mix of shifting economic policies, trade developments, and monetary decisions, Canadian investors are confronting a fresh wave of uncertainty, particularly surrounding the value of the Canadian dollar. The loonie has experienced notable volatility in recent months, a trend influenced by a complex blend of domestic challenges and international pressures. From inflationary concerns and interest rate expectations to geopolitical tensions, these forces are not only affecting currency markets, but also reshaping how Canadian investors approach risk, diversification, and long term asset allocation. To help us further break down what Canadian investors should be watching, I'm now joined by Brendan Caldwell, Director at Caldwell Securities Limited. Brendan, thank you for the time today.
Well, thank you, Theresa. They should be watching the sky in case it's falling.
Now, why has the Canadian dollar declined recently, and what does that mean for Canadian investors' portfolios?
Well, it's a funny thing because if you were to ask a Canadian what the dollar is doing, they actually would have said it got stronger in the last little while because the only measure that we pay any attention to is against the U.S. dollar. And during the depth of the elbows up tariff crisis, which is still a problem, it's just not nobody's treating it like a crisis anymore. During the depth of the when announcements from the White House are coming fast and thick, our dollar got down to say 67 cents or thereabouts US, and now it's rallied to roughly about 72 and a half cents US. So you think, well, the dollar's actually gone up. But compared to the rest of the world, be it the euro or the pound, or Swiss franc, or the yen, the Canadian dollar is actually been in decline. We've got the second weakest currency on earth. The U.S. dollar has declined considerably since the tariff talk began several months ago. It's just that we've gone down less compared to the rest of the world than the American dollar has. It's an interesting thing, but it's as much as Canada and Canadians are thinking, well, we're not going to buy US anymore, kind of the rest of the world is thinking that. And so there is less demand for US dollars to pay for US stuff. Now, it can be good for the United States. A weak dollar, at least in the short term, can be good because it makes the cost of manufacturing or well, just in general in a domestic market to be cheaper. But longer term, I mean, having the weakest currency isn't going to make you the richest country.
Now,
So
sorry,
yeah,
please continue.
no. So that's just it. So it's an interesting conundrum. So we're rallying against our major trading partner, but yeah, against the rest of the world, we certainly are weaker.
Well, you mentioned the tariff war. So, how are the upcoming U.S. trade moves and the August 1st deadline influencing Canadian currency risks and asset flows?
Well, again, people seem to be a bit numb, actually, that the impacts are beginning to be felt. I mean, if you're a young person right now, there was no summer job for you really anywhere. It's very difficult to break into to get new jobs for young people coming out of university. So, I mean, the employment numbers have been stronger than what people expected. Housing starts have been stronger than what people expected. But I mean, the leading indicator of hiring, just the jobs just aren't there for folks. So I'm for young folks. So it's I think the economic chickens are coming home to roost as regards to the tariff. So it'll be interesting to see what the autumn brings.
And what monetary policy decisions from the Bank of Canada and the U.S. Federal Reserve are shaping expectations for the loonie?
Well, that's a funny one. I think most observers, market pundits, and traders think that the Canadian Central Bank, Bank of Canada, is going to keep rates unchanged in September, and they may well. Certainly, if economic numbers seem to be a bit more robust, inflation has been a bit lower than the 2% target. So it would seem that perhaps they have room to cut interest rates. At least the theory goes that higher rates tend to slow the economy down, tend to tamp down inflation. So if a lower inflation rate gives the Bank of Canada some scope to cut rates, but there certainly seems to be a lot of um, suggestion that the inflation numbers might be understated. I mean, the tariffs themselves are going to raise the cost of everything. Even if we do not have countervailing tariffs, even if we don't get into a tariff war, even if we drop our elbows, so to speak, and not have tariffs on incoming U.S. goods, the end of worldwide globalization and free trade seems to be in the offing, and the prices for everything are likely to rise as either higher cost domestic production replaces foreign production, or there are tariffs on foreign production coming into, if not Canada, at least the United States. So the cost of everything is likely to continue to rise. And as we're seeing in the public or semi-public sector, both the uh, Postal Workers Union and the Air Canada Flight Attendants Union are either threatening to or actually on strike again. So wage pressures are continuing to be there, even if the price of goods isn't going up. Wage costs, which are a big factor, are there as well. So, long-winded way of saying that the Bank of Canada has the scope potentially to cut rates, but most people don't think they will, at least not in September.
Well, on the increase of goods, how are rising gold and oil prices influencing the Canadian dollar and investor confidence in resource heavy sectors?
Well, it certainly helped our market, but you got to keep in mind the gold and oil are kind of the flip side of the U.S. dollar because both commodities are priced in U.S. dollars, and as we said, the U.S. dollar is literally the weakest currency on earth because not just in Canada but all over the world, uh, people are less inclined to buy U.S. dollars, U.S. bonds, U.S. products. There's kind of a global boycott going on the U.S because of not so much what they're doing in terms of raising tariffs, but how they're doing it and the uncertainty that the White House is creating in the world. So nobody knows if a deal gets announced today and it's changed by tomorrow. So Canada thought we had a deal. In fact, we thought we had, in the words of the president in his first term, the best trade deal ever negotiated in the history of the world. Well, turns out now the White House thinks that it's unfair. So, with all that uncertainty, fewer people are buying the Canadian, fewer people are buying the U.S. dollar, which means the price of oil, the price of gold, looks like it's going up, but not necessarily if you're Swiss or British or European or Japanese. It's just that in terms of the Canadian dollar and the U.S. dollar, it's going up because our currencies are so weak. But since our big part of our economy, the second biggest after financial services, is energy and followed closely by mining. Having strong commodity prices is very helpful to those sectors, and it's been reflected in the TSX, the Toronto Stock Exchange Index, which has outperformed most of the rest of the world this year.
And is Canadian fixed income currently a relatively safe haven amid trade and currency instability?
It's safe if unexciting. It would seem unlikely that longer term rates in Canada will go up anytime soon. The flip side for people, to the extent they have mortgages, for a number of years, starting in 2022, I had suggested people lock in rates, but I'd be much more amenable to them having floating rate mortgages now because it is possible, depending on people's financial situation, of course, and how much certainty matters. It's possible that rates actually come down over the next year or so, maybe not starting in September, but over the next year or so. So if that's the case, yes, that tends to be good for the bond market. If you buy a bond that's yielding 5% and then in the next 6 months or a year, bonds of a similar term are being issued at 4%, means your 5% bond is going to be worth more and the price will go up. So probably a decent investment, Canadian fixed income at this point, at least in Canadian dollar terms.
Well, Brendan, as always, thank you so much for the time today. We appreciate it.
Thank you, Theresa.